So if that's the case, the valuations have to be a concern. There is a sense right now that if you have valuations the way that they are, in the face of rising interest rates, there has to be something else behind what's going on. Why are investors seemingly willing to pay up more for a company's dollar in earnings or for every dollar in sales they generate, even though interest rates have made it more prohibitive to do so?
Well, that's a great question, and I think the question is the answer. I think there is a fear of missing out, and now there's a complacency, and we see it in every market cycle. Greed eventually replaces fear. And the panic we had in 2022, which sold off just about everything on the growth side, has disappeared. I can't speak to the psyche in any other way to pay up this premium. Now, surely NVIDIA and these great companies, and we just saw an AI chart earlier, they are going to be at the forefront. But earnings are going to be the story in this summer, even on a broader level. How is all this Fed action, all this Fed tightening, a 2-year at almost 5%, is it going to have an impact? And does the Fed continue to raise rates? I'll tell you, if they don't, and we have this massive quick drop in inflation, maybe that's the Goldilocks for this mega cap tech trade at high valuations. But if Jerome Powell continues his march towards 2%, I think names like that are going to sputter.
All right, if they're going to sputter, what's going to take their place? Is it going to be some of the stocks that over the last couple of years have been that so-called value trade? I think energy, perhaps. Some people have said financials, despite the fact that we had some turmoil over the industry over the last several months, given regional banks and everything else. What is the place to be if you're not going to be in mega cap technology?
Well, it's a great question, and I don't think it's going to replace the run-up. I don't think value is going to replace what we saw, 30% move and more in specific stocks. But in terms of getting some return, I do think you have to look at valuations, and I think energy is going to be a good place to do it. Even if we have a mild recession, I think the single-digit multiple on big oil and what you see in the XLE and the dividend yield of almost 5% makes them attractive. Banks got a big scare, and some of that's a little overdone. We understand the asset liability was a specific company issue. So if we look more broadly at financials, I think you can get into financials, whether it's, we like the insurance ETF, we like the XLF, we like broad exposure to financials that aren't subject to single bank risk, a single Monday morning surprise. And I think that if people stay with lower valuations, they're going to have better valuations, they're going to have lower risk if we have a Fed surprise, an earnings surprise, or a wild card event.
And Mark, it's already a hedge on inflation in some ways. We're talking about that energy trade just now. Are there other ways to stay a little bit more hedged on that kind of upside inflationary story if it were hypothetically to play out?
Well, that's really going to be a tough one. I think if you are worried about inflation, that's going to be a negative for stocks. And I think if you have a chance to earn 5% in a 2-year treasury or shorter, I think, as boring as it sounds, I think if you're facing this realization that valuations have run up, inflation is still a public enemy number one in the eyes of Jerome Powell, I think hugging the short end of the yield curve can be your friend to wait it out. I don't think you need to force the shot. Investing is a longer-term proposition.